Curious about your thoughts on this stimulus package. $1 trillion, $1.2 trillion. Markets wanted it, but they still don't seem satisfied. What's your take? Are we perhaps worried about how we'll pay for it?
Thanks for having me. I think certainly you've seen very rapid responses, first by the Federal Reserve Bank over the past few weeks with their intermediate rate cuts, rolling out QE, doing the commercial paper facility yesterday and the primary dealer facility. And now we've moved on to the fiscal front, which I think will have to be the most important front of the fiscal stimulus package and the stimulus package. The markets right now, I think, are just wading through what are very volatile times, what are a very constant flow of news, both about the impact of the coronavirus on the economy, which looks like it's going to be larger and larger. We actually published a report this morning. We think that we will see the largest quarterly decline in U.S. GDP on record in Q2. And then these fiscal stimulus packages, which are growing in size and size. And I think for a good reason. I think you need to have a large fiscal stimulus package. As Kevin noted, it needs to be rolled out quickly to help households and businesses. And the market will, over time, I think, reach a new equilibrium. But it does take time, given the size that we're seeing, given the dollar needs that people have in selling treasuries. And you also had a big amount of corporate supply yesterday. So the market is digesting a lot of information in a short amount of time here.
So, Matthew, walk me through that. You're looking at the largest quarterly drop in GDP in the second quarter ever, more so than 2008. How does this quarter compare to 10, 12 years ago?
Yeah, so in 2008, the largest quarterly decline that we had was about 8.4%. When you go back to the 1950s, in 1958, we had a 10% decline. I think the difficult part with this is that we really have no historical parallel. We have nothing to anchor how we think about the economy, where you have a big closing down of large portions of the economy. People can't go out and spend. I think the difference right now to 2008, significant one, is that during that period, services spending by the consumer remained relatively resilient. That's almost 50% of GDP. If that remains resilient, it helps to support the economy. It seems like that's not going to be the case over the coming weeks. Even if you have these checks rolled out, people are not able to go out to movies, they're not able to go out to dinner, they're not able to go out to bars and restaurants. So we will not have that same buffer, I think, from the consumer and consumer services spending in particular that will allow a bit more resilient recovery. We think it's going to be temporary, and we think the economy recovers in the second half of the year. But I think you are having a historically large disruption to the U.S. economy over the next few months.